Hey everyone, welcome to the KE Report in a daily editorial. On Thursday, April 24th, we are chatting with Brien Lundin, editor of the Gold Newsletter, and our host down at the New Orleans Investment Conference this year happening November 2nd to 5th. Brien, I actually just booked my flight recently down to that conference again, so looking forward to seeing you and all the companies and speakers that will be presenting there. Let's talk precious metals market as volatility continues to reign supreme. Gold recently touched 3,500 and then pretty quickly gave up $200. It feels like $100 moves in the gold sector are a regular occurrence week after week, at least in the last couple weeks. And that also ties in with 1,000 point moves in the Dow a few days over the last few weeks, too. So the one thing we can say is that the gold price is still around that 3,300, even higher level, a strong gold price. And that's also in the face of generally declining US dollar. Really, everything in the US seems to be selling off, and gold being looked at as a safe haven. Brien, what's your takeaway from, again, gold's move to 3,500, quick retracement, and now really fighting around this 3,300, right now, 3,350 level?
Yeah, Corey, you put it perfectly. It's been amazing, the volatility up and down, but mostly up, frankly. Let's face it, over the last couple of weeks. I put out a piece yesterday where I noted that I'd gone to check the markets in the morning, and the tab that I had open to check the markets hadn't updated. It wasn't on auto update, so it was still, unbeknownst to me, stuck on yesterday's values, and it showed the Dow down 600 points and gold up 108 points. And then I realized that it wasn't updated. So I reloaded the page, and all of a sudden it was the Dow up 550 points and gold down exactly 108 points, $108. So it was just a complete reverse symmetry and extremes in both directions for both assets. Now, if you look at what happened, it was really interesting. I mean, every bit of evidence that we had gotten during gold's really parabolic rise, where we had a few $100 up days over the past couple of weeks, every bit of evidence pointed toward China. And not just the central bank of China, but certainly including that, but also Chinese citizens. We had Chinese gold ETFs having as much trading volume over the first couple of weeks of April as they got in the full first quarter of the year. We had, to me, apparent heavy buying by the Chinese central bank, which was accompanied by rising treasury yields, i.e., either non-participation in the treasury market or selling treasuries, and the dollar being sold off. So it was all part and parcel of that selling America trade. And this was strong, powerful buying. But in the West, it was interpreted that one of the driving factors was the Trump tariff war, was the Trump threats to fire Jerome Powell, and that was part of it. I would grant, but when that seemed to be walked back yesterday, then or the day before yesterday after market close, the Western traders said, "Well, that game is over," and started selling gold viciously, and that's where we got that hundred and something dollar down day in gold. Well, as we speak today, gold's up again 40, $50, and the buyers, the big buyers, have stepped right back in because they're still afraid of the volatility, not in the markets, but in US politics and in trade policy. And that's going to take years to mend. It will take not just the end of the Trump administration, but it may take another presidential administration or two beyond that before the world regains the trust that it used to have in the US dollar as the global reserve currency. And it may never regain that level of trust. So the gold has emerged as the antidote to dollar weaponization. And I think we're going to continue seeing central banks adjusting their reserve mix to focus more on gold. That's something that's going to go on for years. And while I I don't know whether we're going to see that kind of parabolic rise that we saw the last couple of weeks in gold. I really hope we don't. And I hope we have a more sustained orderly rise because it really got overheated. And, gold bugs were not that disappointed to see a day where we had the gold price crashing and taking some of that froth out of the market.
Yeah, Brian, it's such a stew of different factors. I mean, everything from, like as you outlined, the central bank buying to the fights with Trump and Jerome Powell, which once those eased up, people said, oh, that's why gold's correcting. But there's still all the geopolitics concerns. There's issues with Iran. There was supposed to be a peace deal in Ukraine, then the peace deal's off in Ukraine. And so there's all these things gyrating around, but there's also so much uncertainty just in the markets and in the politics that people are going to safe havens. And the only safe haven that's really standing out is gold because, as you mentioned, the dollar hasn't been there, and neither has the bond market. It's been a telling factor that the bonds didn't get a huge bid when the equities were selling off, which would have happened in past times. So when you see gold standing out as the sole safe haven, a lot of people have been claiming, even financial institutions, that it's a crowded trade. But the reality is, most people don't own gold. Most people don't own gold stock. So it's not really a crowded trade. It may have been overbought and in need of cooling down. But what's your response to people saying it's a crowded trade? That implies that everybody on your block has positions in gold, and that's just not the case.
Yeah, it does. And it also implies, I mean, the old rules of investing where, markets gain greater and greater enthusiasm until there's an exhaustion of buyers, and then we have a crash, and then there's, the sentiment goes in the dumps, and there's the exhaustion of sellers before it can go back. These peaks and valleys, the typical madness of crowds that we've heard about for so long, they all rest on the argument that investors are playing the game. And what we have now with gold aren't necessarily investors that are driving the price. It's central banks, it's political strategy, it's all wrapped up in it. And if you're looking for deep pocketed, strong handed investors or buyers for an asset, it's hard to imagine anything deeper and stronger than nation states. And that's a good bit part, if not the majority, of the buying so far in this bull market. Interestingly, what we've started to see this past quarter is that the Western investors are starting to get involved, but not in the physical metal because they look at what gold has done over the last 14 months or so and feel like they missed that part of the play. But the mining stocks are still, at long-term low levels or still long-term values based on any number of metrics. And that's how they're starting to play it. That's why the gold stocks, the majors and the major indices, actually about doubled the performance of gold over the first quarter. And that's saying a lot because gold did very well. It was up 15 or 16% in the first quarter, and the mining stock indices about doubled that. So we're seeing what I believe, and I know this is a dangerous thing to say, but I really believe this time is different. This is a metals and miners bull market that I would argue is unique without precedence in that we had gold soar and the metals and miners did not follow along and we did not get Western investors involved. And now they are starting to, and their only entry point that shows any value or potential is through the miners. So that's why, I think this is the year for the mining sector.
It has been encouraging to see the stocks outperform gold, but Brian, in all fairness, we have seen Western investors even come into gold. Just in Q1, almost $13 billion from North America went into gold-backed ETFs, and we've actually seen some outflows from GDX. So still a bit of that dichotomy there of investors playing the gold side, but also trickling into the stocks. It's one thing we've been saying, though, is that there's a lot of stocks that have been doing well in this sector. Yes, it's not everything, and it's especially not the juniors, all of them running higher, but we've seen many stocks at 52-week highs, all-time highs as well. And I think that money is starting to filter into some of these other plays. Even the explorers, we're seeing more financings being completed for higher dollar amounts. And it really looks like a lot of money going into the ground this year. We are coming into drill season. There are some major programs underway and starting up this year. How are you looking at the juniors in this environment where many are more cashed up and more money is going to be spent on drilling this year.
Yeah, I think it's really exciting. I'm like a kid in a candy store as I look around, because it's not only that so many companies are still, even after some really significant moves in a lot of the juniors, they're still at long-term lows. And it takes some imagination, frankly, to realize and remember that even the companies that have doubled in value, historically, in a bull market environment, many of these juniors would be trading at 4 times today's levels, and nobody would be blinking an eye at those kinds of valuations. But I'm also seeing a lot of really good drill results coming out already. And this is still fairly early in the year to get a flood of drilling news, but we are getting some news here and there from companies and some remarkable intersections. And so the money's being put to work, even these early funds that are starting to flow into the market. A lot of great projects and great targets have long been identified, but have been hamstrung by the lack of capital to adequately explore them. That's being solved as we speak. And the one piece of advice that I think I can give investors universally is make sure you're on this train, because it's leaving the station right now. There are a lot of great companies out there. Don't be afraid to pay up a little bit. Don't try to be too smart by half and wait for this market to come back to you. That was the game we could safely play over the last 2 or 3 years, but I'm not so sure we can play that game going forward. I had some stink bids in, and not really stink bids, but bids for some companies just a penny or two below the market over the last couple of weeks. And finally I succumbed and said, just buy the damn thing, because it wasn't coming back to me. The prices weren't coming back. And, and we may get, earlier this week, we had the big sell-off, and that was a great buying opportunity, which I told people at the time. But you can't plan on that. You can't count on that. You've got to find these better companies and get your stakes while you can.
Yeah, Brian, such a good point that a bull market playbook where the pullbacks are more shallow and they don't go as deep as we were used to is way different than a bear market playbook where it seems like the pullbacks last forever and they go deeper than you expect. So in this kind of environment, you buy the pullbacks and you hope you get a good entry, but some of these stocks are going to start running and you don't want to be stuck chasing. So sometimes it's better just to bite the bullet or at least get one tranche in place. One of the areas that we've seen some success in the juniors has been with the juniors that have decided to either buy production or go into production. And we've talked about this a little bit with you, Brian, in the past when we mentioned Heliostar or Integra. You've seen the same thing with Discovery Silver buying the gold mining complex, the Porcupine complex from Newmont. But another company that's recently ramped up into commercial production is Luca Mining. And you were mentioning off mic, it's one that has your attention. It's performed very well now that they got both mines up and running. What's your take on Luca?
Yeah, things always take longer than you expect. And frankly, we've had Luca in our portfolio since about 2 years now, almost exactly 2 years. And, we're up nearly a triple on the price right now. But the big gains have been over the past, couple months, really. And we were waiting for this to happen over the past 2, 3 quarters. We were always expecting the next quarter to be the big one and then the next quarter after that. But they kept running into operational issues. Finally, they bit the bullet, raised the money that they need to make the capital improvements that they needed to sustain production and grow production, and then actually start exploring again at their two main projects. Their two only projects. But they did that. They bit the bullet. And although it was delayed, what the company is doing now and what the company will be doing over the next couple of quarters is something we fully expected and have been talking about for a long. It just took a little longer than we had hoped. And I think it's a great play going forward. As I mentioned, they're doing exploration. They've gotten past these hiccups. They built a spare parts warehouse. They were operating without the typical or an adequate spare parts inventories whenever something broke down, where they might have to wait a couple of weeks before they could get the part in. Now they're running, like gangbusters, pedal to the metal, in exploring ways to increase production at both of their projects. So really like Luca going forward. They're paying down what remaining debt they have aggressively. And I think that's another real inflection point for the company. Once it becomes debt free or largely debt free, then the economics, the financials will really sing. And I think they're going to get rewarded for that in the market.
Yeah, when you look at how that company is being run right now, everything is going in its favor, right? Exploration is underway. They're looking to expand, grow production. They are growing production. They're cash flowing much better right now. And as you said, they're paying down debt. So everything's kind of moving in that direction. Is that where you're focusing a bit more though? Is it on these earlier stage producers or these producers that have been in production and seem to be turning the ship around, also helped largely by the much better precious metals prices?
Well, if I have one consistent quality, I would argue that it may be lack of focus. I'm kind of all over the board in these things. I can't resist and a good drill hole play, and there's a lot of those ones out there right now too. But if there is a sector that I think is a great bet with a really favorable risk reward trade off or dynamic, it would be those companies that have big resources. Again, I've talked about this repeatedly, but companies that have already outlined resources, whether they have them with economics on them yet or not, I think those are going to be the first targets for the major miners whose pockets are overflowing right now. And it won't be much longer before they really start looking at the juniors and looking at building their resource or their reserve pipeline. So there are companies out there that I think are going to be near the tops of those shopping lists. Banyan, I think, is one of the top ones out there. Another developer that I've recommended now for about a year and a half, actually, no, just a little under a year, is Meridian Mining. The economics on their project in Brazil are absolutely astounding. And I've just been buying that personally over the last week or so. I think that's another one that's going to come off the board at some point to a major before they ever get into production. So there are companies out there that are real value plays, and to be fairly valued in the market, they could rise 4 or 5 times from the current levels. So you're getting the potential of a drill hole play, but because they've already got this resource base backstopping their value, they have much less risk.
A lot of these companies do have a whole lot less risk. Again, helped by better metals prices. That should lower cost of capital for some of these companies too. But I think it's also something that we're waiting to see is a bit more financing packages being announced for the wide range of development stage companies, projects that are ready to be built. They just need the funding to do it. A little bit more support from the market definitely helps that angle. Brien, we'll wrap it up here. As always, great chatting with you, and especially good chatting with you when we are in this market that is a very strong precious metals environment, even for the companies, and the companies are really taking notice and have been doing quite well. Again, Brien Lundin is the editor of the Gold Newsletter and our host down at the New Orleans Investment Conference, November 2nd to 5th. Click the link in the show notes to learn more about the Gold Newsletter and that upcoming conference. Brien, as always, thanks for your time. Hope you have a great rest of your week.
You too, guys. Thank you so much.